Thank you so much for inviting me today and for that nice introduction. I think obviously we are seeing as a company increased interest from all over the world in sustainability. And from our perspective, sustainable finance starts with ESG. And so what I want to talk about today is both how we think about sustainability at BlackRock, some of the things that we see with our clients, and then also talk about the regulatory or policymaker piece of it. So the first thing is thinking about sustainability at BlackRock. We think of it as having 4 pillars. The first being in the investment process itself. As you start thinking about ESG today, I think actually somebody here, or there was a professor, or there you are, has done some research on women on boards. More and more we're seeing research that shows it's not either or. It's not I can do well or I can do good in my investments. It's I can have my cake and eat it too. If you start thinking about these as investment factors and taking a long-term view, we actually believe that companies with better ESG scores will do better over the long term. So trying to gather that data, bring it into the investment process, and let portfolio managers make informed decisions using good data. Second is investment stewardship, and Shinbo, raise your hand. Shinbo is here in Singapore. We have an effort that is global. It includes a team in Asia Pacific, a team in Europe, and a team in the Americas. And we set guidelines and engagement priorities, and we're really looking to engage with companies both one-on-one and also in larger settings. Obviously, we're talking about thousands of companies. We can't really meet with every company one by one frequently, but we can let them know what things are on our mind, what our engagement priorities are, what our voting guidelines are, how we're thinking about issues that are emerging issues, and try and move the dial. I will say it's a long-term game. It's not something that you snap your fingers and all of a sudden everything changes. This is something that the pace of change might frustrate some people as being too glacial, but we do take that longer-term perspective. Just like we want companies to take a longer-term perspective, we have to do the same. The third is on the product side, and as I mentioned, more and more clients are asking for sustainable solutions. So we have to think about how we can deliver that. It's both what's the investment product, but also what's the mechanism for delivering it. Retail investors in one market maybe have access to UCITS. Retail investors in a different market have access to what we call in the US 40 Act funds. Retail investors may have access to ETFs. Institutional investors may have access to private funds that are offered more globally. So what we're trying to do is look at our product range and identify what investment strategies fit what products and where we can create things that we can then make available to different types of clients in different parts of the world. And then fourth, I say it's the fourth pillar, the one that no one ever talks about. And this is, how do we operate our business? And I feel pretty strongly that there's nothing we should be asking companies to do that we're not willing to do ourselves. So whether you look at governance and a commitment to gender diversity and diversity in general, not just gender, we are clearly a US-based company listed in the US, but if you look at our board, quite a few of our board members are either non-US citizens or dual citizens. And so really looking at those kinds of issues and how do they apply at BlackRock. Same thing with E and S, looking at data centers, for example. Data centers are one of the key levers in asset management. We're not manufacturing things. We don't have a lot of levers. But in that one, which is a very important one for energy usage, we have designed new data centers using energy efficient designs and then located them where there is hydropower. So we're really taking advantage of everything we can in that kind of example. And then on the social side, what things are we doing for our employees? And we have a whole host of programs, both internal things, but then also helping them with their own philanthropic efforts. We give people time off to do volunteer work. We help identify volunteer opportunities. And in each local market, we have generally some sort of BlackRock giving type situation. So we're looking for things that we can do internally with employees in terms of their own development and career advancement, but then also looking at ways we can impact the broader communities that we work in. So I mentioned the clients, and we think of clients as asset owners, right? Who's the end investor, who actually owns those assets and will benefit from the returns of any particular portfolio. And what we find is ESG means really different things to different asset owners. So if you say ESG or you say sustainability, one person is thinking it's about things to avoid. Let me eliminate tobacco, carbon, weapons, defense, some category to eliminate. There's another group of clients who are looking forward and saying, how do I advance a particular issue? So for example, we have a number of impact investing investors. They're looking at specialty products that have maybe a wind and power type focus so that you can develop, add capital and develop more sources of alternative energy. And then we have people who are simply interested in a broad portfolio where in each sector, maybe it's companies that score better in ESG. So rather than eliminating a sector or a group of companies, taking the best in class based on operational excellence and other criteria. So as this market is evolving, what we're finding is one of the challenges is getting some kind of common language and framework to even talk about it. But we're working hard on trying to help in advancing that as well. The other thing is if I step back and I say, well, where are we? I don't like to use baseball analogies. I'm not really a baseball fan, but people seem to like those. But where are we in some sort of game, if you would? I think a lot of people tend to look at this as a glass half empty, and they're very frustrated. Well, we should do more of this, and we should do more of that. I actually have had the opportunity to step back and sort of take stock and say, well, where are we really? And I actually see the glass more as half full. If you look over the last few years, the amount of engagement on the topic, the things individual companies are doing, the things that asset managers as well as policymakers, we're at a much better spot than we were even 5 years ago. So some of the stats that I'll just throw out to give you a sense, more than 20% of the companies in the S&P 500 as a benchmark in 2011 were producing sustainability reports and any data that you could use. Today, that number is closer to 85%. And while that's a US example, I think it's indicative of what we're seeing more globally. Technology. We are obviously very big users of technology. And what we're finding is we're able to use technology to take in data from various sources and then try and give that information to our portfolio managers in a usable format. We're using big data to analyze the data, to clean up the data, and really try and turn it into that usable information. On the negative side, and it's both a good and a bad, and I'm going to get myself in trouble here with Leon because I'm going to talk a little bit about the proliferation of standards. And today, the Task Force Climate Disclosure is certainly a well-respected group, but we have SASB, GRI, IIRC, and the list keeps going on. I met with a company just recently in the US, and they said, you know what? We're not going to report to the Climate Disclosure Project this year because we have so many competing standards, and we actually think the Task Force for Climate Disclosure is a better framework. And I said, well, that's fine with us, but you do realize you're going to get an F from the Climate Disclosure Project. And they said, yes, we've decided that that's okay. Now imagine, unless a whole group of companies says, I'm going to move to this new standard, and we're all going to get Fs. There's going to be this one company, and they may be an outlier. how does that affect them? And, do companies care or not? So we have this challenge that nobody wants to merge together and combine their standards, which, a lot of the companies are saying that they have survey fatigue, and we really need to figure out a way of getting more consolidation and more consistency of the standards themselves. Some of the things that we are using: third-party sources of data, MSCI, Sustainalytics, RepRisk, Verisk, Maplecroft, Thomson Reuters, Asset4, and SASB's data. So that just gives you an idea of the things we're bringing in and then trying to somehow collate and synthesize. We do use the data for a bunch of different research projects. Today we are looking at creating proprietary ESG analytics, as well as assessing materiality. So this is a project in process. We see uses for the data across our platform. So I think a lot of times people think of this as an equity exercise and really very much focused on individual companies. I would say it's much broader than that. So whether it's in the fixed income, we look at emerging markets and the corporates and how to take into account ESG factors there. Green bonds, we have a world-class expert in that area. That market is growing very, very rapidly and really focusing on financing of green projects. We have a lot of demand for that from our asset owners to be able to invest and commit capital there. Even in real estate, we're now taking climate data and using that to look at, some of the locations. What are the risks? Are you in an area that's prone to flooding? So really, again, incorporating data from many different sources. And then, of course, on the equity side, I think that's the obvious one. Our fundamental active equity team has developed what they call an ESG risk window. And on the iShares side, in terms of index investing, we obviously use the stewardship team to be looking at different companies and then also working with index providers to create new indices that maybe have that tilt to them. So a lot of different ways. I'll say even in the cash group, I was surprised myself, but the cash group found that they were getting demand from asset owners, and they've now come out with some cash products where the selection of securities reflects an ESG tilt. Let me just mention regionally, very different. So as you go from one region to another, I would say Europe has, in this area, been a leader. I would say Asia is second, and the US is probably third. This is something that it is not just regionally, but within the region, different countries taking different measures, some of them very much voluntary, some of them more regulatory driven. And this is, again, an emerging area as well. So let me wrap up with what we think regulators can do and should do. And we do have some concerns that while Europe is a leader, they can also maybe go a little bit overboard. And given it a sense, just this year alone, they've started a taxonomy project, which we think is good because getting that common language would be helpful. But they've also put an investor duty on disclosure. They've got low carbon benchmark requirements coming out. They have suitability characteristics in MiFID, and all of them have elements of sustainability in them, which makes it hard to sort of see the whole picture. And we've discouraged them, or encouraged them, I guess, not to have overlapping, but to look at the rules already on the books and then maybe fill in gaps, but not keep building higher and higher towers. So what things can regulators do? And I think this is true in all markets, whether it's Europe, Asia, or America. One is create incentives for asset owners. So at the end of the day, the capital being allocated is by a company or an individual who owns that capital. And if they have incentives, and this is especially true with insurance companies who maybe have longer liabilities, for them to invest in infrastructure projects, if the capital requirements are telling them one thing and the ESG aspects are telling them something else. Which one do they follow? So I think you can create positive incentives for asset owners, whether it's tax, it's accounting, it's regulatory. There's a lot of different ways. Second is to encourage disclosure by companies on material information. Ideally, if we could get to one or some common set of criteria, that would be the best situation, but certainly encouraging companies to disclose data where it is material to their business and do it in a way that investors can capture that data and use that. A rationalization would be helpful. Third is to encourage the development of sustainable investment products. So I think of this as like a speed pass, right? You get on the highway in the morning, and if you've got a car full of commuters in many markets, you get to go in the faster lane. And it seems that we could do things that would be the carrot rather than the stick on the product side, where maybe the approval process is a little more streamlined, or there's some incentive, some positive incentive that helps you bring products to market a little bit faster. Again, some of the tax code, the OECD came out with something a couple of years ago called base erosion something or other, BEPS. And while there was reason for it, it also had the negative of discouraging cross-border flows. So addressing some of those anomalies. And lastly is recognizing the corporate governance and the stewardship standards. Today there are almost 20 different codes around the world. Again, some rationalizing wouldn't be such a bad idea, but at least recognizing them and encouraging the uptake of those. So in conclusion, this is certainly a long journey. We've made a lot of progress, but there's always room for improvement. And thank you again.